Welcome to the Real Estate Investors Weekender Podcast. This podcast is brought to you by the award-winning editorial staff at NREIOnline.com. Let's jump right into this week's top news, features, and blog posts.
Hello and welcome to the NREI Weekender with your host, David Bodamer. Today we're going to be diving into the top news stories of the week. Hello, David. How are you?
I'm doing all right. How are you this week?
Fantastic. We got some more stories to cover. I'm excited.
Yep. Never stops.
It's always news somewhere, right? Kind of like it's always 5 o'clock somewhere. There's always news somewhere.
Yeah, and we always have to pick and choose what we can cover. This is such a busy industry.
Oh, yeah, absolutely. I know you guys do a ton of writing during the week, and so now we're just kind of how many stories are we covering today?
We're going to look at 4 stories from the week from our coverage. So we're going to do 2 that focus on a couple of trends we covered in the multifamily sector, a piece that has to do with CMBS loans on retail properties, and then a last piece that's just a kind of a quick update on investment in the self-storage sector.
All right, sounds good. Where do we start?
So first story that's going to recap is a piece that we actually posted on Thursday. It's about how labor shortages in the construction industry have had sort of an unexpected effect when it comes to multifamily rents, which doesn't seem like they would necessarily.
Yeah, I'm wondering how you make the correlation there.
Yeah, exactly. Which was like, my reaction as well when we were doing the piece, like how do you get from A to B? But basically what's happening is the pressures on the construction market and the shortage in finding skilled workers that can actually complete the projects that that developers are trying to do is slowing down the pace of development a bit. So what that is meaning is that demand growth is supply growth is slowing while demand is still pretty strong. So it's just it's disrupting what the supply demand balance should be, to the point now where more demand than the supply can now keep up with. So once you do that, then suddenly, then you're going to have upward pressures on rents because occupancies are going up. You can't, you're filling all these units, and that's the end result.
Do we see anything on the horizon as far as the labor shortages changing, or are we still? Is there anything coming?
I don't think so. This is the job market that we're in, and the overall employment picture is, low unemployment and huge demand and not enough people to fill some of these jobs. So I don't necessarily think it's from a developer standpoint, it's obviously good because it means that higher rents are higher incomes for owners and developers. Maybe it's not so great for renters who might have been expecting things to be a little bit more affordable than they are now becoming. And I think it's also possibly a good thing in that one of the classic things that can happen in real estate is too much, overdevelopment. That's how we end a lot of cycles or get to when things turn is like things are going great. We, get too many construction cranes growing, build too many buildings that people can fill. So this actually is a counterweight to the potential of overdevelopment within the multifamily sector, which has been a looming concern for a couple of years. And it certainly has happened in some markets. It's not happened in every market, but there has been some overdevelopment in parts of the country. So this is kind of putting a brake on that. So I think actually on a net basis, this is probably it's sort of an unexpected benefit from the strong job market to create this brake on multifamily development, which is then ultimately manifesting in these rent growth being a little bit stronger than what people had anticipated.
Yeah, you may or may not know the answer to this question. I'm just curious, if we were to see a increase in laborers for whatever reason, and buildings were being built quicker, have you ever seen a situation in a market where all of a sudden building owners are reevaluating, going, I should probably lower the rent a little bit to be more competitive with these newer buildings that are being built and the influx of available properties? Have you ever seen something like that?
I think that would be the inverse. If the development pipeline can speed up again, and the projects are delivered faster. There's more supply. If the supply demand come out of imbalance in the other direction, that creates a downward pressure on rents.
Yeah.
So, that would be the upshot, is if we do get to, if this backlog or if this labor shortage is resolved in some way to the point where development can pick up again, then it will change those supply demand balances again.
Yeah, absolutely.
Just one thing that I wanted to also point out that was in the story too was, so just like in terms of the concrete terms, what we're talking about is that in June, the average rent on all types of apartments rose by 0.7% on a 3-month basis. That's according to data from Yardi Matrix. Similarly, looking from another provider, CoStar, they break their statistics into what they consider 4- and 5-star apartment buildings, which generally we would call Class A buildings. They experienced annual rental growth of 3.1% year over year as of the end of the second quarter. Growth at Class B properties slowed down to about 2.5%. But so a little bit less, but it's still pretty good. And then what they call 1- and 2-star properties, annual rent growth had averaged 2.5% as of the end of the second quarter. So this was something so the upshot is the rent growth is something that we saw across all quality of apartment buildings.
All right, David, anything else on that story, or are we moving on?
So this was looking at a different set of data, talking to some other experts. It just was about what's happening, what kinds of projects are prevalent right now in terms of development, and finding that developers in the U.S. are continuing to build more low-rise apartment buildings than any other type of construction. Now, this is not a change from historical patterns. Low-rise apartments, which we could define as garden-style apartments, which are about 3 stories high. They typically fit about 26 apartments on an average acre. And this has historically been the most prevalent type of apartment construction, especially if you're talking about anything built outside of a city. So between 1990 and 1999, according to, again, data from Yardi Matrix, about 90% of all new apartment constructions were low-rise buildings. So what I think is striking is that now the number in 2018 was that it's still more than half, but it's only 56% of construction now that are in low-rise buildings. So I think so. It's sort of like, I think, what the point of the story is that while there's an awful lot of attention paid to high-rise urban apartment buildings, and in some cases trying to build those kind of projects in suburban settings, and certainly there's an uptick of it, it's not the dominant way that apartments are built yet. Even though there's a clear trend line at work here, which is, those have gone from being like trophy exceptional projects to being almost, to being more of the norm. But still, on balance, the bread and butter of doing the garden style, more, low-rise projects is a pretty consistent and pretty strong part of the business. And that's true in a lot of different markets, even in like markets that you would think would be more dominated by high-rise construction, like Brooklyn and Queens are 2 of the most active markets in the U.S. for the number of low-rise apartment projects completed in the past decade or so.
Really? It seems strange to me because you've got limited space. Why wouldn't you go up to 8, 10, 12 stories? I
mean, there are parts of Brooklyn and Queens that are more spread out. And I think also, the thing about building, while there certainly are those projects getting built, it's harder to get those zoned and it's harder to get those approved in some cases. So There may only be, even in some urban settings, there may only be a certain part of the city or a certain part of the borough in this case where you can get that done.
Well, I understand that. I'm sure there's regulations all over the place for how high a building can go, but in those areas where a building can be 10 stories, I would think that somebody would want to get close to that instead of doing a 3-story building or a 4-story building. I mean, obviously, I've never done all the research on cost per floor, per units and all that jazz. So somebody much smarter than me has done that, I'm sure. But it just seems silly if you have that option to go up a few more floors. I would think that would be more lucrative in the long run, but I could be completely wrong.
No, I don't think you're wrong. I think but there are parts of Brooklyn, like, downtown Brooklyn, you do have that. And it's just I think it is the question. But there are parts of Brooklyn and Queens where where you can only do low rise.
Got it.
So, but then I think there are other places where they might really want to do, there are markets where developers I think would love to go higher and just right now can't because of the local zoning conditions. Mm-hmm. I think, and what's also interesting looking at some of the data is that where the markets where you're seeing a lot of this construction still being completely dominant are places like Texas, places like California, places like in and around Las Vegas. Mm-hmm. So where it's just still the traditional garden style apartment buildings are the ones that are being built up to the point where they're almost like 90% of the projects in those markets.
Got it. Is it easier to get loans for smaller buildings? I mean, I would assume so because you're borrowing less money, so maybe that's also a factor.
That's definitely could be a factor. That also often is contingent on the quality of the borrower and their track record. Mm-hmm. So, like, if you have more of a track record as being a successful developer, you're more likely to get more financing.
Of course, yeah,
and the more equity you can bring to the table. But yeah, for sure, smaller, less complex construction projects, I think, would be easier to get financing for.
Yeah, that guy Billy Bob that built his last condo out of sponges, probably not going to get that next loan there, bud. So I get that completely. All right, David, what is our next story we're covering today?
So now we're going to shift gears and take a look at what's been happening in terms of CMBS loans for retail projects. I think one of the things that we've talked about fairly, that we've talked about consistently in this podcast in the past few episodes, and also has just been a trend more broadly within the commercial real estate sector, is just the continued struggles of the retail sector as it goes through dealing with the pressures and the evolution being forced by the rise of online sales, and both how that's putting some retailers out of business, transforming how others do their business, creating a lot of vacancies. So it's creating a lot of pressures on retail landlords. What this piece was looking at is how, given some of the risks associated with retail, how are lenders approaching financing the sector? In some of the recent data, what it's shown is that CMBS lenders are doing, and again, I guess it's given all that, it's not going to be a surprising finding, but that CMBS lenders are doing less business or doing a lower percentage of their overall lending volume is going to the retail sector. So they now are, if you compare it to their books and the percentage that may be going to office, hotel, industrial, retail, other sectors. Historically, even just a few years ago, maybe 30 to 40% of their business on CMBS issuance was for retail properties. Year to date in 2019, only 15% of CMBS of issuance has been gone to the retail sector.
All right.
So I think that's kind of like the headline, which is that so CMBS lenders are taking a little bit of are being a little more hesitant about getting into the sector.
Yeah.
The projects that they are going after, then not surprisingly, are they want what they're calling, what one of the people we talked to called bulletproof. So it would be the projects that are the highest quality assets, that have the best tenants, that have the highest sales per square foot, the ones that are the most basically, riding out the storm the best are going to be the ones that can get the financing that they need right now.
Yeah. Well, that makes sense. Everybody wants a bulletproof program.
So, I think another aspect of what the data from the sector is showing us is that, one of the ways that we look at the CMBS sector, since these are usually about 10-year loans, and you're monitoring those pools over time to see what the delinquency rate is. Within the pools, what percentage of the loans are 30, 60, 90 days delinquent. Currently, there's a couple, and there's a couple of data providers that keep a really close eye on this. It's Moody's and TREP, and they're both telling a similar story, which is that the delinquency rate for the retail sector is higher than it is for any other commercial property type. They have slightly different numbers, but they're close enough. Moody's reports the delinquency rate at 5.5% right now, whereas TREP says it's about 4.4% compared to the broader commercial real estate number of, in Moody's case, 3.5%, and in TREP's case, 2.8%. So in either, the retail delinquency rate is about 2 percentage points higher in both sets of numbers.
Mm-hmm. All right, David, what else do we need to know about this story?
So the last piece of it is that, those numbers that I'm referring to are mostly for loans that may have been done up to 10 years ago, which was some of that stuff may even be like the tail end of before the financial crisis, which a lot of it, which we roughly call CMBS 1.0. Now we're into CMBS 2.0, and we're still in the early stages of some of those retail deals. So in terms of looking at, so there's some looking forward now around, okay, is that same kind of delinquency problem going to show up in the newer batch of loans? And the early indications are, the delinquency rates are not as high, but it is already showing up in some of the newer loans too. So this is not an issue that's going to be resolved through the mechanisms of the lending that's happened. This is a foundational issue that's in the retail sector that's going to affect all of the loans that exist. So we can kind of then move on to our final story of the week.
Sure.
Which is an update on investment in the self-storage sector. It's a sector we tend to focus more on the major food groups of industrial, office, retail, multifamily, hotel as well. Self-storage is one of the ones we don't touch on as much, but this week we did have an update just based on some of the numbers we're getting from some of the brokers and some of the data providers that just shows that the average price of self-storage properties is continuing to rise. Investors are especially interested in older Class B and Class C properties. And as one of the brokers we spoke to, Ryan Clark, who's the director of investment sales for Skyview Advisors, said most of the new money entering the market is doing so with an investment thesis centered around pursuing value-add deals. I think what they're seeing is that looking for some of these Class B and Class C properties, there's more potential upside. So prices are continuing to rise for those assets. In contrast, the average prices for Class A properties are not rising as fast as they are for some of those Class B and C properties in the sector. On balance, what we're seeing is that from data from Yardi Matrix, it's our third time quoting their data this week, Class A properties, Class A self-storage properties sold for an average of $118 per square foot so far in 2019. That's actually down $3 per square foot from compared to 2016.
That seems pretty large. I mean, large drop.
Yeah, I mean, $3 per square foot, and considering that general prices for a lot of assets have been rising during this period. And then again, when you and that's more broadly, but when you specifically even talk about self-storage, their numbers show that prices on Class B properties rose to $90 per square foot, up from $86 per square foot. And on Class C properties, they rose from $62 to $72. So basically they fell $3 per square foot for the Class A properties. They rose $4 per square foot for Class B, and they rose $10 per square foot for Class C. So there's this compression in the spread between the highest tier and lowest tier properties in terms of what investors are paying, driven by the perceived upside that they see on those respective tiers. So that's kind of our takeaway from that one. And, I think overall this just, self-storage continues to be a popular niche play for investors, in part because it's seen as a safe asset class. There's not a lot of it's seen as being recession resilient, and I think overall the dynamics point to investors wanting to take advantage of that.
Nice. Sounds pretty good for investors.
So, yeah. Well, that's what we want to see. We hopefully that this, continue to ride this cycle out as long as we can.
Yeah, absolutely. All right, David, thank you so much for the updates this week, and we'll look forward to your reports next week as well.
All right, sounds good. Thanks for tuning in, and look for more coverage and more stories that we didn't touch on today at NREIonline.com.
Perfect. And thank you all for listening to the NREI Weekender with your host, David Bodamer. If you have not subscribed to the podcast yet, you're missing out. So please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. Again, thanks for listening today. For everyone at the NREI Weekender, this is Aric Johnson inviting you back next week for all the news that matters to you. See you next time.
Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of NREI Informa. The content has been made available for informational and educational purposes only.